Gold's really gone sideways. But I think it'll be interesting to see what happens if we do get a big breakout in gold. Gold takes out 2,000, maybe 2,100, 2,200 once the price of gold really starts to go up. I mean, maybe right now they feel they can go slower, and they're taking advantage of the fact that the price has been relatively stable. It is a bit surprising that it hasn't already moved up given what's going on. I think that's causing some people to kind of doubt that it's ever going to move up, because they'll say, well, if it can't move up given the circumstances, it'll never move up. Well, that's just not true. It's just taking time.
Gold prices hit a 3-month low below $1,930, but recovered due to selling pressure on the US dollar. The dollar weakened by over 1%, making gold more appealing to investors with other currencies. Gold's performance next week depends on market perception of the Fed's rate outlook. Hawkish stance could weigh on prices, while a dovish outlook could boost them. Regarding this issue, Schiff recently shared in his tweet, "Don't believe the hype on the Fed's hawkish pause on rates. If the Fed really was hawkish, it wouldn't have skipped this rate hike. There's a good chance that the Fed's next move on rates will be a cut, not because #inflation is lower, but because the labor market finally cracks." Schiff recently appeared in an interview with Paul Barron Network, in which he highlights that the Fed has been raising interest rates in an attempt to cool inflation, but so far, these efforts have been unsuccessful. When the markets realize that the Fed will not be successful in its battle against inflation and will eventually concede, inflation is expected to surge, causing gold prices to skyrocket. Schiff also believes that it is important to consider that current interest rates are historically low. A rate of 5% is not considered high when viewed in a broader historical context. For example, the Federal Reserve's funds rate has typically been below 5% since the adoption of fiat money in 1971. Schiff added, 5% is only considered high in comparison to the rates we have experienced over the past 14 years or so. Now we are getting into the interview of Schiff to listen to Schiff's point of view.
Collateral damage to the economy, to the banking system. I mean, in his Q&A yesterday, he said that he's never going to tell Congress to stop spending or stop the deficits. He said that's none of his business. Fiscal policy isn't any of his concern. Well, that means he's going to have to monetize all those deficits that he refuses to criticize, which are skyrocketing. There's going to be tremendous pressure on the Fed to create inflation, not to fight inflation. And so when the markets realize that the Fed is not going to be victorious in this fight against inflation, it's going to surrender, inflation is going to win, gold is going to go ballistic, so I just, feel that, I'm willing to wait it out, because I know how much it's going to go up when it finally moves. And I'd rather own it now and wait than have to scramble to buy it later at a much higher price. Well, I kind of think the Fed is done, at least for the time being. I don't believe that they're going to follow through with the additional rate hikes that they're forecasting between now and the end of the year. I think they paused for a reason. I think if they really were committed to continuing the inflation fight, they wouldn't have paused. They would just raise rates, because they've admitted that they're still not high enough and inflation is a bigger problem than they thought. So why pause? I think the reason is because they're also paying attention to the damage that higher rates are doing to the real economy, and in particular to the banks and the financial system. And so I think they don't want to put any added pressure on such a fragile situation, so they stopped hiking. But I don't think it's going to matter. I think that just leaving rates where they are is too big a burden for the system to handle. And you have to keep in mind that rates are not high. 5% historically is low. I mean, if you go back to the era where we've been on fiat money, go back to 1971, and where have the Fed funds rates been? 5 is not high. It's only high in relation to where we've been for the last 14 years or so, in this unprecedented period of monetary excess. But we now have the highest inflation since the 1970s, yet interest rates are nowhere near where they were back then. So they've got a long way to go up, but of course the Fed can't let them go up, which means inflation is what's going to go way up. That's why I'm so bullish on gold, because I'm very bearish on the dollar.
In the interview, Schiff highlighted that the major countries like China, Russia, Saudi Arabia, Brazil, and India are reducing their dollar holdings and seeking to unload their surplus dollars. This is a significant development, as these countries have traditionally been the largest holders of U.S. debt. The reasons for this shift are complex, but they include concerns about the U.S.'s rising debt levels, its record budget deficits, and its trade deficits. The reduction of dollar holdings by these major countries will exert significant pressure on the dollar. He also added that the reduction in foreign demand for dollars and treasuries can potentially lead to a devaluation of the U.S. currency, which would increase the price of gold. Let's move towards the interview of Peter Schiff.
Because the Fed tightening cycle is coming to an end. And so that's been the tailwind for the dollar. It's now going to be a headwind. I mean, it's going to be weakening the dollar. But you also have this unprecedented movement now around the world to de-dollarize. Countries that were significant buyers of dollars and then U.S. Treasuries are now sellers. China obviously doesn't want our dollars. It doesn't want to buy new dollars. It wants to get rid of dollars it owns. Same thing, clearly Russia, is not a dollar buyer anymore. Saudi Arabia doesn't appear to want dollars anymore. Brazil, India, you got major exporting countries that have huge dollar surpluses in their trade and large dollar reserves in their holdings that want to unload. So this is going to put tremendous pressure on the dollar at a time where our budget deficits and our trade deficits are in record territory. We've got $1 trillion a year trade deficits, $2 trillion a year budget deficits. There's no place for those $3 trillion to go. So this is massive inflation because for years and years, America exported its inflation. We printed money and sent it out to places like China. They used the money to buy treasuries, which kept our rates low. And then they shipped us goods that they produced, which kept consumer prices low. Right. Now we're going to import that inflation back because now the Chinese aren't going to want to buy these dollars. And so therefore Chinese goods are going to be more expensive. We're not going to buy as much stuff. So our prices are going to go up. And now the Chinese are going to take those dollars that they used to hold in treasuries and they're going to come shopping in America to buy our stuff. And a lot of it isn't going to be the new stuff that we make, but it's going to be the old stuff that we already own. So it's like a giant repossession. But all this money is going to come in and prices are going to go ballistic. Certainly, the bankers didn't anticipate that the Fed would be this aggressive. In fact, early on, I didn't think they'd do it either. I didn't even think they can get away with it. I thought that pulling the rug out from under the economy, would topple it faster. So I was kind of surprised that they were able to get rates to 5% without more damage. Now, of course, we got that damage and they backstopped it. We had Silicon Valley Bank, Signature Bank, these massive failures. And there would have been way more had the government not come to the rescue. It already would have been a much bigger financial crisis than 2008. Now, all they've done really is been able to hold it off. But the momentum is building as rates stay where they are and more, low yielding debt matures in a higher rate environment. But the pressure continues to mount on the banks because the value of their collateral is collapsing. Not only the treasuries and mortgage-backed, but their commercial loan books are imploding. Yeah. And they're losing their deposits because their customers are taking their money back because they could buy a money market fund and get 5%. They're still paying 0 on checking. You get maybe 0.25% at most on savings accounts. Yeah, you can get a couple of percent if you buy a CD, but why lock your money up for 3 or 5 years when you can get more just putting it in a money market and getting a checkbook? You can get money market checking, at a brokerage firm and get 5% on your money.
Gold initially declined, falling below its 100-day moving average, but quickly rebounded as the value of the dollar tanked. This sequence of events highlights the inverse relationship that is often observed between gold prices and the performance of the dollar. A stronger dollar makes gold more expensive for investors holding other currencies, which dampens demand. Gold found support in the market as the dollar index approached a 5-week low, which had a positive impact on its price and overall performance. When the dollar index is low, it means that the US dollar is weaker relative to other currencies, making gold relatively cheaper to purchase. That's all from our side. Make sure to hit subscribe and like button if you like this video and click the bell icon if you want to watch more videos like this.